Welcome to Iron Financial. This is the explainer, where we help you forge a significantly stronger portfolio and cut right through the market weakness. I am your lead analyst, and as always, joining me on the floor today is the Market Skeptic.
Hey everyone, look, I'm just here to find out if the numbers we're seeing today are made of genuine structural steel or if we're just looking at a fresh coat of paint slapped over a crumbling foundation. Are we looking at actual sustainable growth, or is it just a usual corporate hype?
Exactly. And to answer that, today we are running a severe stress test on LexinFintech's Q1 2026 earnings. We're using them to gauge the structural integrity of the broader financial markets. Let's get right to work. Now, before we grab our hard hats and drill down into the individual balance sheets, we absolutely have to inspect the broader macro environment. You cannot build a durable long-term portfolio if the ground beneath it is constantly shifting. So the most crucial question we're facing right now is this. Is the global fintech market built on a solid, immovable foundation, or is it getting ready to just collapse under the heavy lifting of today's macroeconomic crosscurrents?
Honestly, it feels like the market is throwing off some highly conflicted, heavily mixed signals right now. I mean, on one side of the street, we're seeing private market confidence in AI infrastructure staying absolutely rock solid, right? Those valuations are holding up incredibly well. But then at the exact same time, you pan over and look at the broader equities. The Dow experienced a completely brutal 6% drop through late March. When you have private capital enthusiastically saying buy and the public markets aggressively saying sell, you've got a massive structural misalignment. So are these fintech companies actually forging ahead, or are we literally starting to see the load-bearing walls fracture under the sheer weight of these higher interest rates?
To really answer that, we have to look closely at the macroeconomic heavy lifting. On paper, sure, the global financial services market is aggressively expanding. It is estimated to reach a massive $38.58 trillion. That's trillion with a T in 2026. This is being driven largely by massive digital banking adoption and complex cross-border payment infrastructure. But beneath that massive, shiny top-line number, actual consumer credit stress is intensely ratcheting up.
Oh, absolutely. Let's just look at the U.S. numbers as a reliable proxy for the global consumer right now. Credit card balances just expanded to hit a staggering $1.23 trillion in the first quarter of 2026. And the issue isn't just that people are borrowing more capital. The real issue is that they are fundamentally struggling to pay it back. Credit card net charge-offs have risen to roughly 3.4%. The lending industry keeps deploying the slick corporate PR phrase, calling it post-pandemic credit normalization. But let's strip away the fancy jargon for a second. What that actually means in practice is that these lenders built models for a certain baseline of defaults, and the everyday consumer is currently blowing right past those risk models. People are exhausting their personal savings and defaulting on unsecured debt. From where I'm standing, that looks like a devastatingly heavy burden placed right on the consumer pillar. And when charge-offs rise like that, the foundation of every single consumer finance company out there gets brutally, brutally tested.
You're spot on, and that foundational stress is what's forcing a massive valuation reset across the entire industry. The structural steel of 2021, it's buckling. We are currently seeing large-scale traditional banking entities moving in and purchasing once untouchable, mature fintech platforms at extreme liquidation-level discounts. We are talking 40 to 60% markdowns below their venture-backed peaks from 2021 and 2022.
Yeah, and the most glaring, absolutely undeniable example of this reset is Capital One swooping in and buying Brex for $5.15 billion this past January. Now, look, $5 billion sounds like a massive pile of capital, right? Until you pull up the historical blueprints and remember that Brex was valued at an astronomical $12.3 billion back in 2022. Let that sink in for a minute. That is a catastrophic markdown. Over $7 billion in perceived equity just evaporated into thin air. The big legacy banks aren't intimidated by these startups anymore. They are basically rolling in and buying up high-grade tech assets at salvage yard prices. They're aggressively shifting away from just partnering with fintechs to outright owning the underlying platforms so they can instantly accelerate their own AI-native credit engines.
And honestly, it gets significantly worse for the startups sitting further down the food chain. Fintech funding in key financial hubs globally dropped by a mind-numbing 75% between 2023 and 25. That is a completely devastating contraction in available capital. It is a total liquidity freeze. Imagine the water just being shut off on a massive construction site. When the funding dries up by 3/4, you really have to look at the structural integrity of the entire sector and ask, what does this weakness mean for the mid-cap players? What does it mean for the international companies trying to survive and scale in this incredibly hostile environment? If the big legacy banks are just sitting back, waiting to buy up the distressed giants for pennies on the dollar, who was looking out for the mid-market? Section 1. LexinFintech, inspecting the revenue steal. That brings us perfectly to the core focal point of today's explainer. We needed a live candidate for a real-time balance sheet stress test, and we have one. LexinFintech, trading under the ticker LX, released its unaudited Q1 2026 financial results today. They are a major digital consumer tech service provider operating over in China, sitting right in the crosshairs of all these macroeconomic headwinds we just discussed. Let's start by looking at their top-line strength, what I like to call the revenue steal. Lexin reported a very solid 3.3 billion RMB in total operating revenue for the first quarter. That is up 6.6% year over year. Okay, but why does that specific 6.6% number matter so much? Because you have to consider the context. In a macro environment where capital is heavily constrained, where funding has literally dropped 75% globally, and where consumers are stressed to the absolute breaking point, forging a 6.6% revenue increase is not a trivial achievement. It's like pulling a heavy load straight uphill. It proves there is real, tangible demand for their specific financial services ecosystem. They aren't just barely surviving the pressure. At the top line, they are actively expanding their structural footprint. And if you look at the sheer volume numbers, they absolutely support that top-line growth narrative. Lexin facilitated 57.9 billion RMB in total loan originations this quarter. Now, that's a year-over-year increase of 12.2%, which is fine, but what you really need to pay attention to is the raw velocity. It is a robust 15.9% increase strictly quarter over quarter. In a span of just 3 months, during a period of intense global economic tightening, they managed to accelerate their lending velocity and successfully put a massive amount of capital to work through their proprietary platform. But here is what really matters structurally. If you take a close look at the breakdown of those exact loan originations, they aren't just stubbornly doubling down on traditional consumer loans. They are heavily diversifying their entire load-bearing architecture. Their non-consumer finance businesses, specifically things like installment e-commerce, offline inclusive finance, and their B2B digital intelligence technology, now account for nearly 50% of all originations. They clearly recognize the cracking foundation in pure unsecured consumer credit, so they are strategically shifting the load away from a single point of failure and distributing that risk evenly across multiple business lines. Lexin CEO Zhao Wenjie addressed this shift directly in the earnings release. He stated that the initial transition between new and established business drivers has been completed, and we are steadily advancing toward a sustainable, diversified, and healthy growth trajectory.
Wait, hold on a second. Sustainable, diversified, and healthy. I mean, come on. That sounds exactly like textbook corporate PR spin designed to completely distract us from the fact that consumer lending is getting incredibly risky right now. Are they actually building a new foundation or just rebranding their old risky loans?
Well, the data actually suggests it's a legitimate structural pivot. They are actively positioning themselves not just as a direct lender taking on all of the default risk, but rather as a digital intelligence bridge. They're taking their proprietary Yunxi Technology Pro software solution and using it to connect consumer traffic platforms directly with traditional financial institutions. They are essentially becoming the tech infrastructure for the banks, rather than trying to compete against them. When you look out at the broader financial landscape, the median price-to-book multiples for traditional banks and trusts have been steadily rising over the last few years. The traditional legacy institutions are getting stronger, and they're deploying far more capital. So Lexin's strategy here is incredibly calculated. They want to capture value by being the vital, AI-native software layer that these expanding traditional banks absolutely need to efficiently deploy their capital. They are basically building the toll road, providing the intelligence infrastructure, instead of just taking on all the direct uncollateralized credit risk themselves.
Section 2. Structural cracks, income and delinquencies.
All right, let me jump in here because the top-line hype from the CEO is great. Sure, 57.9 billion RMB in originations sounds like some really impressive heavy lifting, but I am absolutely not buying a stock just because top-line revenue is up. I want to inspect the actual structural cracks hidden beneath that shiny revenue steal. Because when you look at the bottom line, the money that actually matters to the shareholders, this foundation is taking incredibly heavy damage. Net income attributable to shareholders outright plummeted to 201 million RMB. That is a massive, highly concerning 53.2% decrease year over year.
Okay, but you have to look at the adjusted numbers.
Look, even when you look at the adjusted net income, which strips out things like share-based compensation and investment losses, just to give management the benefit of the doubt, it is still down 51.6% to just 228 million RMB. The disparity between unadjusted and adjusted really doesn't save them here. So revenue is up 6.6%, but profits are literally cut in half? That is a massive red flag flapping in the wind. The structural integrity of their profit margins is failing right in front of us. So the real question is, why did the income foundation crack so badly? Well, the earnings report gives us the exact diagnostic: heavier provisioning and a structural shift in their loan mix. While their guaranteed income went up significantly to 727 million RMB, so did their expected loss rates. To be fair, though, aggressively increasing provisions in a volatile macro environment is a highly responsible conservative measure. It's exactly like reinforcing a bridge before a hurricane hits. They are fortifying their balance sheet against future defaults. Fortifying it, sure, but at what cost to the investor? They're having to set aside a massive chunk of their capital just to cover potential defaults on off-balance sheet loans funded by their institutional partners. Yes, it's a responsible move, but they are essentially paying a brutally heavy premium just to reinforce a weakening credit structure. The sheer cost of doing business is eating their core profitability alive.
And here is the core mathematical reason for all that heavy provisioning. The 90-day plus delinquency rate has crept up to 3.5%. Just at the end of 2025, it was 3.1%.
A 0.4% jump might sound incredibly small to an amateur.
Exactly right. It sounds like a rounding error until you apply the stress test math. A 0.4% increase across 57.9 billion RMB in total originations represents hundreds of millions of RMB in newly distressed assets. That is real money evaporating. It is a clear mathematical indicator of growing, undeniable credit stress on the consumer side. Look, no matter how much B2B technology they deploy or how great their software is, if the end consumer is buckling under the weight of inflation and failing to pay back loans after 90 days, the entire architecture of Lexin's profitability is at severe risk. Section 3. Market reaction and forward guidance.
Those are incredibly valid concerns regarding the bottom line, and frankly, it's exactly why we run these iron financial stress tests in the first place. Now, we need to see how the public markets actually absorbed this raw data. Let's transition over to the live trading floor and see how investors stress-tested this earnings report in real time.
The immediate fallout on the floor was decisive, and let me tell you, it wasn't pretty. The stock dropped 4.66% immediately following the news, pushing the current trading price down to a mere $1.84 per share. That single downward move wiped out roughly $16 million in market valuation instantly. Just gone. And what's really telling here, what really shows the structural weakness of their narrative, is that this continues a harsh historical pattern. Over the last 5 earnings releases, Lexin has consistently seen negative next-day price reactions, averaging a 5.14% drop each time. The market simply does not trust the structural durability of their earnings, despite all those flashy top-line growth metrics.
And honestly, management clearly sees the cracks too. Their forward guidance for Q2 2026 is extremely cautious. They explicitly stated they expect total loan originations to remain relatively flat amid persistent macroeconomic uncertainties. Listen to that phrasing carefully. When a self-proclaimed high-growth fintech company tells you that their core volume is going to absolutely flatline, you have to take notice. The growth engine is stalling out because the macro environment simply will not support it right now. I hear the skepticism loud and clear, but let me counter that with a highly bullish data point that proves their pivot is actually mitigating that exact risk. Look at the installment e-commerce gross merchandise value. It experienced a massive 95% growth, reaching 2.198 billion RMB compared to Q1 2025. Furthermore, e-commerce platform service income shot up almost 82%.
Okay, but why does e-commerce matter if the loans themselves are flatlining?
Because facilitated retail and e-commerce GMV is a fundamentally safer bet in a hostile macro environment compared to pure uncollateralized cash lending. By financing direct purchases, they are securing the transaction within their own ecosystem. It completely proves that their new framework, moving away from just handing out raw credit and moving into tightly integrated retail financing, is actually functioning and scaling incredibly fast. It's a much more durable, weatherproof revenue stream. Plus, management is deploying serious financial reinforcements to support the stock price. They aren't just letting the foundation sink into the mud here. They have declared a final dividend of 18.8 cents per ADS payable in June. On top of that, they've actively repurchased 9.6 million ADS for about $39 million. That represents roughly 5.9% of all their outstanding shares.
Hold up. Pumping $39 million into buybacks when your net income is down 53%? That could incredibly easily be interpreted as artificially propping up a sinking ship. Are they just trying to manufacture a fake floor for the stock price?
It's a fair question, but you have to look at their actual cash flow. They have the liquidity to execute this. Using your own cash flow to buy your equity back at a massive discount and pay shareholders is a classic, highly effective structural support tactic in weak markets. It shows management fundamentally believes their intrinsic value is far higher than a mere $1.84. Section 4. The verdict. Final inspection.
All right, it is time to bring all these complex blueprints together. We've seen the macro environment shifting, the solid top-line revenue growth, the brutal profit drops, and the real-time market reaction. Let's juxtapose the two sides for our final inspection of LexinFintech's structural integrity. The bull case relies heavily on the momentum of user engagement. Active users are actually up 8.6% to 5.17 million. Registered users are sitting at a massive 250 million. E-commerce GMV is exploding, and they are actively returning hard cash to their shareholders.
But the bear case points directly to the foundational cracks that matter most to durability. Net income is down a staggering 53.2%. Delinquencies have climbed to a highly concerning 3.5%, and management is outright bracing for flat growth next quarter due to severe macro uncertainties. You simply can't pay dividends forever if the users are defaulting on the underlying loans.
Here is the official Iron Financial verdict. LexinFintech is successfully forging a diversified ecosystem. The structural pivot to B2B technology and e-commerce is entirely real, and it is generating massive transactional volume. However, they are currently caught in a brutal, tightening macroeconomic vice that is aggressively squeezing their core profitability.
Exactly right. The sheer cost of doing business, the heavy provisions, the escalating risk management, is eating their profits alive. The real-time market skepticism we saw is entirely justified, which is exactly why the stock is sitting at salvage levels under $2. Until we see that 3.5% delinquency rate definitively bend back down, the true long-term durability of this company's bottom line remains highly questionable.
Market Skeptic. So, we leave you with the ultimate question. Looking at LexinFintech, with its massive loan volume, smart ecosystem pivot, and aggressive stock buybacks on one side, and its plunging net income, cautious forward guidance, and rising consumer defaults on the other? Is this a solid, heavily discounted foundation to build your portfolio's future on? Or is it a structural value trap just waiting to cave in under the pressure of higher rates? That is the stress test you have to decide for yourself. Thanks for joining us on this explainer. Stay intensely focused and keep testing your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.